Hey, here we go. Hi, guys. Welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And we're talking about all different things, not necessarily related just to stocks. But today we are going to talk about a stock. It's a position that I've had in the portfolio for a while, and we'll talk about that and why I'm so excited about it. Thank you for watching. If you haven't already liked and subscribed, I would greatly appreciate you doing that. If you're new to the channel, I'm a popular investor on E-Toro. I spend a disproportionate amount of times speaking about that, whereas my main aim is to continue running the options fund and derivatives book that I do privately. And so sometimes these things interconnect, but most of the people out there are interested in the analysis on certain positions. And if I get interested enough, usually if it's available on eToro, I will look to put it into the portfolio. So today we're going to talk about most hated stock, which I love. Every time, every time something's just hated, my ears prick up. And I heard one interview from Michael Milken from College Street Value Fund the other day talking about one in particular. It's a small little Aussie stock, so not many other people out there will be interested, but it's it's so hated, it's so bad that I started to think to myself, I'm starting to get the hang of this whole contrarian investing if I haven't already by now. In any case, today we're going to talk about Arch Resources, why I have put it as a reasonable position in the portfolio, why I think it's so unpopular, and also why I own several options on the stock. So without further ado, let's get into it. Here's a quote from the great man, the great Jim Rogers. If you haven't read Jim Rogers' stuff, you really need to. You need to listen to his interviews, fantastic. But the books are even better than the interviews, in my opinion. So if anybody laughs at your idea, view it as a sign of potential success. This has been something that means a lot to me because it's happened so many times throughout my life. I lost count. I honestly can't count the amount of times I've come up with an idea or I've been made aware of an idea from left field, and I've been able to incorporate it into my given endeavor at the time, or simply tell people about it. And they obviously think I'm crazy, and then give it, sometimes 6 months, but usually about 3 years. Everyone comes around. They always try and claim the idea as their own, and no one gives you any credit. So this is something that is like my life story, but I think it's very appropriate for where we are now, moving into today and tomorrow's macro environment for investing. So coal, I view as the new tobacco trade. And I'm not the first one to kind of see parallels between these two, but I'm going to put into words that hopefully convey the way that I'm thinking about it. The popular people hate it. Okay, coal is just unfashionable. There's a hell of a lot of controversy around whether the science behind why they hate it is any good or not, but we'll leave that for another day. One thing we can all agree on is that nobody really wants to use coal if they have an alternative that will provide a similar or better energy return on energy invested. And everyone's like that because the sulfur is a byproduct of coal burning for electricity. It's just nasty. It brings about a lot of smog. So the big thing is that the world have decided that no one's really allowed to invest in this production. And if we just kind of choke off the supply of finance or capital to allow these new coal plants and coal mines to come online, then eventually they'll just magically disappear. The problem with that is that a hell of a lot of the world still runs and will continue to run even more so on all sources of power. They'll need all sorts of power, and that includes coal. Okay, so this is outdated sentiment. This is wrong. If you think that coal is going away, I don't know what to tell you, but I just completely, I don't see how. Even though I would love to see us move into more nuclear power where appropriate, because obviously that's got a better energy return on energy investment. I just think that you're just not, you don't know what you're talking about, basically, if you think the coal's going away. You've got a billion Indians, a billion Chinese, and who knows, all these other different developing populations in Africa. These guys need power, they want power, and they can't afford some of the other methods of obtaining that power. And so they will continue to be using coal right where their populations are growing, and they hit the S curve, which I've spoken about ad nauseum, so I'm not going to repeat, where not only is the population growing, but the number of people that hit a certain income bracket that allows them to spend a little bit more starts to go through the roof. So they're spending on food and energy are the first things that they will spend money on. And so the energy requirements, the energy demand, it just simply has a much more than a step function. It's more like a geometric function. Coal prices currently reside on the moon. If you've been paying attention out there, it's just incredible to see what the prices have done over the last year, and there doesn't seem to be any sign of stopping anytime soon. The sector was basically on life support in pre-COVID, debt and dying industry, couldn't get access to capital, all that sort of thing. Very, very similar to the oil industry. And so they've had such a bumper last, call it 12 months of coal prices. They've been able to smash down their debt. And now at the almost at the end of Q2 in 2022, moving into the last half of this year, which is normally where you get most of the demand for coal, or the main demand is at the back end. And these guys haven't got any more debt to pay down, and they're starting to just absolutely print cash. Okay, they're hemorrhaging cash, as I said. So what is the idea? That's the macro in terms of the macroeconomic and geopolitical environment. What's the idea when it comes to the meso environment in terms of coal as an investment? And so think about this. When you had the tobacco stocks, and of course, because smoking is horrible, don't smoke, it's very bad for you. You got into this situation where, because everyone knows it's terrible for you, people assume that you are literally killing your own demand in that case. And that is what's happening. But if you look at the performance of these businesses, demand has stayed level or slightly dropped, but it's all about that supply. This is the Jim Rogers Trade 101, where he talks about, in hot commodities, he talks about lead. Lead became extremely unpopular. It was on the nose. No one wanted to know about it. So nobody invested in any more mining of lead. And so demand did drop, but supply dropped a lot more. And so when you have that imbalance, the price is going to correct to the upside. And so where you have your competition, in this case, the tobacco companies, legal suits, or it was too hard to be in the tobacco industry, the competition goes away. And so these guys, Altria, the Philip Morris, British American Tobacco, so on and so forth, they've actually been one of the best performing investments you could have made starting at the year 2000. And who the hell would have thought that? I mean, crazy, crazy, crazy. You've got taxes left, right, and center when you're trying to sell cigarettes and whatever else they sell. It's unbelievable. So all that has happened without the stocks becoming more popular, i.e., instead of paying $2 for $1 worth of cash flow, people start to bid it up to $3, $4, and $5, like you've seen with tech over the last 20 years. Instead, it's just been the case the multiples really haven't expanded, but the cash flows have been so great. The dividends alone have been unbelievable. And so if you were to have entered in and simply reinvested the dividends, you basically got similar performance to the S&P or better if you reinvested the dividends. You see the outperformance in this little graph here for just one of those tobacco names, Altria. It's really quite phenomenal, and it's not something that you would expect. I see a lot of parallels with coal at the moment. I do not expect that we're going to be paying even 4 or 5 times the cash flows or the EBITDA for these companies, but they're just making so much money. It's going to be coming back to you in free cash. And so once they have paid off the debt, which they have, they've got 2 options. They've got 2 options. They either buy back their stock or they pay back the dividend. So in this case, there's going to be no shareholders left. It's going to be that they buy back all the stock, and obviously your claim on the future cash flows increase, even if those cash flows remain flat, and you get a very handy dividend. So depending on what your tax situation is, it's certainly something that you might be interested in looking at. I've stayed away from these types of play in E-Toro thus far, just because I don't know what everyone's got different tax jurisdictions. We've got guys from South Africa, guys from England, lots in Australia, obviously. So there's that. But at the end of the day, I really am looking now towards where we are in the macro environment. Cash flow and net asset value versus the price is king. Okay, everything else is a secondary concern for mine now. So let's take a look. Philip Morris, as I mentioned, Altria, and a couple of others versus the S&P over the last, what is that? Looks like 2008. So let's call it let's call it 14-ish years. And you can see that outperformance of all of these versus the S&P down there, which would have returned you 111% over that time. Best performing stock there looks like Reynolds American Total. And you've had more than double the outperformance, which is crazy. Let's talk about Arch Resources. I'm going straight through, guys. Simple presentation because it's very straightforward as far as I can see. It's a coal producer. Okay, it's the second biggest in the US behind Peabody. I own a responsible amount of Peabody options. It's so volatile that I love just selling options into the space. And this is just a cash machine from what I can gather. It's produced more free cash flow in the first quarter than in the last 12 months combined. It's now got basically no debt, or they're at level debt to cash levels. There's restrictions on expanding production in the sense that it's just so unpopular. It's just, who the hell wants to go out there and start to spend a heap of money on producing more coal when everyone thinks you're a bad person for doing it, even though you're saving lives of people in developing economies. But anyway, that's just an argument for another day. The question is, with all this free cash flow that they're generating, what do they do with it? And as I've said, they're going to give it back to us. They're going to buy back as many shares as they deem prudent. That may bid up the stock even more. And then they say, okay, well, instead of doing that, we're going to, it might even be a case of 100% back via stock buybacks and dividends, which we're starting to see in some of those oil plays that I love so much. Okay, a few different charts here. Picture tells the story, right? So we've got our market cap, and we're looking at, to my calculations, roughly 1.4 billion of expected free cash flow this year. So you're paying, not even, just over 2 times the free cash flow. It's insane. It really, really is insane. And if we look here, a few different things to note. We've got our price and SMA at the top. But most importantly here is EV to EBITDA at 1.6. I mean, it's just, I'm probably going to live to regret these words, but it's just very difficult to go wrong when you're paying 1.6 times the EBITDA. You're paying twice the EBIT of next 12 months. I mean, it's a very large margin of error. It's a very forgiving investment. If we get in the investment and something unforeseen happens and the coal price drops, and so their free cash flows drop, their balance sheets are solid. They can ride it out. Okay, if it takes a little bit longer and their EBIT drops in half, or we've only paid in that case for 4 times that year's EBITDA. That's still very, very cheap, guys. And so if you look at the enterprise value over the free cash flow, it's yielding 12% according to the Coifin. I think it's going to do a lot better than that, as you see with the prices that I put in this matrix here. So don't get lost of, here's one I prepared earlier, right? So for this year, and then I'm going out into 5 years. Obviously, you use your own assumptions, guys. This has been taken from the first quarter financial report from the company. They're unaudited. It does say on the quarterly report, sorry, that they're unaudited, but they're in line with the SEC filings, which are obviously audited. And so we're looking at mainly just breaking it down to met coal and then thermal. So met, we're just looking at volume and what prices they're going to get. And this is the tricky part because it's a moving target, right? So people get way too caught up with this as far as I'm concerned. I'm looking at what they have sold it at, okay, and said, does that appear to be fairly reasonable? And I think it does. And use a blended average because you've got your seaborns and you've got different segments that make it up. There's no point going too complicated. Just look at what do they produce, how much of that can they produce, and at what price will they get? And obviously, if you disagree, you can go in there and you can change your assumptions. We look at the cost. That cost, the company's reporting are looking to come down a little bit. That might be different if we do have inflation and your cost of labor, et cetera, goes up, cost of production goes up. Likely that would be offset by the sale price of what they produce, but who knows? You may wish to have maybe a 3 to 5, even 10% increase. When you look at the numbers, it's not really going to matter when you're paying 1 and a bit times the cash flows, in my opinion. So here's our margin, and we get an adjusted EBITDA for met, and then exactly the same methodology for thermal, but obviously we changed to the specific price, and we get a combined EBITDA. We go through, and here are the reports and my numbers for depreciation, amortization, D&A, their interest expense, which we'd expect to drop off moving forward since they'll pay out their debt. CAPEX is set to remain fairly flat because they're not going to look to increase production. Tax rates, they actually have a tax credit this year, so I'd expect them to pay close to nothing because they'll be making back on losses from previous years. But we put that in there. Change in net working capital, and then the SG&A expenses. Then we get a free cash and we give it a multiple. And then that number there is the expected new number of shares by the end of the quarter, thanks to their buyback. So you can allow for that, or you can just have the current shares and you can leave it as is. I'm using both metrics. Down here, you'll see I get a fair value at $192, using a 2x multiple. So if you're willing to pay twice the cash flows, you can afford to pay up to $192, okay, based on that matrix. When you're using commodities, guys, it's very handy to do this because you can change your assumptions. If you just go and you look at last quarter's free cash, then that might be completely different to the next quarter's depending on the commodity, right? So let's take this EBITDA, and I've done it for the free cash as well. Over the next 10 years, I've kept growth flat to even negative in the bear and the bull case, bear and the base case. And I've applied a terminal multiple of 1 for the base and the bear case and 2 for the bull case, assigned a probability of only 10% to the bull case. So very negative. I've assumed that they keep the shares flat. So I'm not even accounting for share buybacks. I'm saying if they just flow it all back as dividends. Here we look at numbers for the EBITDA. Oh, sorry, guys, trying to get the stupid Zoom thing out of the way. EBITDA and the free cash, we get a blended average of $369 at a discount rate of 20%. So if I wanted to make a 20% CAGR on that particular investment, the max I could pay according to this, $369. If we take a further margin of safety, we're still looking at about $244. So obviously we're well shorter or well shy of where that is, as you'll see. So this initial investment, if we use the IRR, is the average price that I've entered it in for E-Toro. And what I'm continuing to do in my arbitrage is just write a heap of puts, right? A heap of puts at basically at the money or close to the money. And if I get put the stock, I get put the stock, great. I can afford to pay up to like $190. So if I get put the stock at 160, that's no big deal. And let's say we use those same base cases for the free cash and we discount it back at the weighted average cost of capital. We're looking at an IRR of around about 33-34%. Okay, so obviously a really attractive IRR based purely on the cash flows. We're not going to get the multiple expansions I would expect, but I think that's a very, very safe long-term scenario. So that's the type of investment that I'm looking to bulk up, make it the bulk of the portfolio. And I think that that's the way to play things moving forward. I think that given inflation, free cash conversion and generation will be at a premium, as well as discounts to net asset value. So that's where we have a lot of the sort of the shipping and offshore plays, where the value of the steel is a hell of a lot more than the price at which the stock is trading. That sum of the parts is worth a hell of a lot more than what it's been broken down as. So the verdict, I'm long the stock, as you know, in E-Toro. It's sitting just around 3%. I may even build it up to 5%. Very high conviction play. Hard to go wrong at 1 to 2 times EBIT. That's the rationale, guys. Okay. People can come in and out of the stock in terms of its popularity. We're still going to be receiving a heap of dividend stream. Coal prices can lower, but demand isn't going away. If coal prices dropped $55 a ton to about $200 a ton, I think that you'd still see this company produce about $2 and a bit billion in EBITDA, and the market cap is currently just over $3. I mean, that's insane. And so their free cash might be a bit less than $1 billion. So we've got a lot of margin for safety is what I'm saying with this particular investment. So thank you for watching. If you haven't already liked and subscribed, I greatly appreciate you doing that. If you want me to talk about different investments, someone's asked me for an update on Petrobras and Transocean. I will get to that, guys. And if you're interested in this type of investment philosophy, you may wish to copy the fund on E-Toro. All you need to do is have the app and then click the link in the description, and you can choose to add funds should you wish. But disclaimer, of course, guys, I'm not a financial advisor. I don't know anything about you potentially watching the video. And so please don't mistake any of this as advice. This is my opinion. This is what I'm doing with my money and just putting my thoughts out there. It doesn't mean that it's necessarily right for you or that it's right at all. Okay, could be completely wrong. So please take that seriously. Always be responsible for your decisions and their associated consequences. Having said that, I hope that you enjoyed the video, and I look forward to seeing you in another video shortly.